Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. And we're going to chat a little bit today about how inflation is affected by the job situation, obviously, and how that all affects the interest rates, and talk about where they are and where we think that they're going. First off, if you look at this slide, inflation remains elevated, and the two things that will keep interest rates high is, number one, if there's a lot of inflation, if people are spending money. Obviously what happens, this after 2020, they lowered the rates to spur the economy. And then when people start spending, inflation goes up, then they raise the rate to tamp down the spending a little bit. You know, it's a lot cheaper to buy a car at 2% than it is at 7%. So people kind of quit spending money at that point. So what happens is the Fed looks at inflation, and if inflation is high, then they'll keep the rates up, you know, to try to tamp it down a little bit. And as you can see, they've been holding pretty steady. They definitely, since the peak of March in 2022, have gone down almost in half. But still, remember the Fed, you know, the lower the discount rate, which is a Fed rate, not mortgage rates, but they do have parallel somewhat, and we'll talk about that. They want their target rate is 2%. Well, you have to go all the way back to, you know, COVID. You know, a year after COVID started, they have it below 2%. So you can see it's still holding steady at 2.9% as of August. And unemployment is holding steady. Look at that, almost all the way across the board. Obviously, during COVID, you see unemployment where it spiked up when people lost their jobs and weren't able to work. And it's gone down. It's been holding steady in that 4% or so. So right now, it's 4.2%, the unemployment. So that's really what they look at also, because if the unemployment, you know, again, is high, you know, what they're basically saying, they have to lower the interest rate to spur the economy. But again, it's holding steady. But the job growth is one thing that the Fed is really looking at now. You can see that the job growth is stalling out. You see with this bar graph, and it has basically stalled out. So really now there's pressure on the Fed to lower the discount rate, which they just did a couple weeks ago, 0.25%. Now, I will tell you, it really didn't affect the interest rates, because the interest rates with the job report started going down in August. So interest rates went down. They were anticipating the Fed lowering the discount rate. So even though the Fed lowered the discount rate, it really didn't bring interest rates down. They were already down to the lowest point they had been in the last year. So that's why the market has been spurred a little bit by that. But you know, people talk about a recession. Look at two in three Americans think a recession is coming. So 67% and 74% of Americans admit that the world news and our current effects affect their financial decisions. The tough part about that is bad news sells. You know, you never sit there and open up the news and hear any good news. It's all bad. And depending on what station, you know, you're watching, you know, you can think that the world's coming to an end. You know, again, if your politics swing one way and depending on an election and such forth like that. But you can see it is a concern to people. Again, yes, we might see a recession, but remember, in most of the last recessions, 5 out of 6, the real estate market actually went up or stayed the same. Only the Great Recession of 2008 did the real estate prices really dive down, because real estate's what led us into that recession. Look what the chief economist for Redfin says. The Fed's in a tough spot. Some argue that with a weakening labor market, it's time to bring the rates down, which they just did 0.25%. Others point to rising inflation, say a rate cut is misguided. The most likely scenario, the Fed will cut rates to stabilize the labor market, viewing any inflation from tariffs as temporary, because that's one of the, you know, the tariffs is what's causing, because prices are all going up, because obviously of the tariffs. But if that assumption is wrong, we could be looking at a rate hike again in 2026. So you're not going to see a lot of, you know, movement in the interest rate. And I'll show you what they're predicting. But you can see, again, he says today's mortgage rates already have the anticipated September Fed rate price cut in. Remember, we talked about that. Even though the Fed cut the rate 0.25%, it didn't really move the needle on the interest rates. As a matter of fact, they ticked up a little bit. This means that when the Fed officially announces a cut, we shouldn't expect a significant corresponding drop in mortgage rate. Obviously, this slide preempted a couple weeks ago. They did lower it a 0.25%. Daryl was exactly right. It didn't do anything with the interest rates because, again, it was already baked in. And you can see mortgage rates declined after the weak jobs market, going all the way back to July when the jobs situation went down. Again, the mortgage rates went down, anticipating that the Fed was going to follow with a weak labor market. They were probably going to lower the discount rate or the Fed rate, which they didn't do it until just this September. But you can see that we were at our lowest point that we have been, in the last year or so as far as, mortgage rates. But here's the predictions. I mean, you got from Fannie Mae and Mortgage Bankers Association, Wells Fargo, and the average of all three. They're saying right now, the average is 6.68%. It's actually a little bit lower than that for the most part, maybe 6.25%, 6.5%, depending on what you get. And the average going all the way, to Q2 of 2026, 3 quarters from now, is this 6.4. So I think you're going to see that 6 to 6.5%, unless something drastic happens, mortgage rates. So you can see listing prices have already flattened. You can see all the way from 17, 18, 19. Obviously, they jumped up in 21, 22. But then you see the tight range that they've been in. And this is average through the United States, but it's kind of, in our area, California too. You can see that, they're not jumping up like they were before, not falling way down. They're staying pretty steady where they're at. And the home price growth is the slowest since the summer of 2023. So we've definitely seen the market stabilize, prices stabilize, as of, just, I would say, we've been talking about almost for a year. We're kind of in a normal market. The normal market was last 18 and 19, 2018, 2019, where if you put your home on the market and it's priced well and it shows well, it's going to sell. If it doesn't look good, or if it's not priced right, it's going to sit. And that's kind of a normal market. You can see that what's been going on, because remember, inventory peaked. We're down about 30, 40% in inventory. It peaked in July, and then basically all the way through August, September, it basically has been dwindling a little bit, but now it's stabilized out a little bit. You can see the San Ramon market, inventory is still going down, as will continue to go, it will go down. And then you see the pendings also have dropped quite a bit because obviously people have pulled back a little bit, which is seasonal. Same thing in the Danville market. Active properties have stayed about the same. Pending properties have obviously gone down. Same thing. Alamo prices active properties have stayed about the same, and pending properties have stayed about the same. Same thing in Dublin market. Dublin market, really the inventory just bumped up a little bit, but for the most part, it's staying about the same. This is what we've talked about. This is all a stable market. And you can see things are still selling in the high 90%, up to 100%. And the average time on the market for the pending properties is about 3 weeks. So if you price your home right and you come out, it's going to be, you're going to sell your home. And you're probably going to sell it near asking price if you price it right in the beginning. One of the things I want to comment on, because a lot of people ask, hey, Joe, matter of fact, I just had an appointment the other day. Someone said, hey, our prices, should we put the home on now or should we wait till January? Well, the way I feel, because right now inventory is going down, and it's definitely a situation where we might see less inventory. Now there's less buyers, but there's less inventory. But then, from February is when the market picks up, the buyers start coming back into the market. And there's a little window there before everyone puts their home on the market, which has, traditionally been a good time to be a seller. But sometimes October is better than February. So what we're telling clients, hey, there's nothing wrong with putting the home on the market. And then if it doesn't sell, then because the market's slow, you put it back on the market, you pull it off and then put it back on the market in January, February. It's kind of, you get like what we say, 2 bites of the apple. rather than just wait and hopefully the market's better in January, February, you actually put it on now. And if you get a good price, then obviously you can jump on it. And if it doesn't happen, well, you're out nothing and you put it back on the market in January. So we kind of call it 2 bites of the apple. If you're thinking about it, give us a call, because every home, we always talk about every home, every neighborhood, every little micro market situation is different in each neighborhood and each city. So, but if you want to chat about it, whether it makes sense to take those 2 bites of the apple or to wait, or no matter what, give us a call. We're here as your consultants. We don't come over with a listing agreement. We wouldn't even know what to do if we needed to list a property when we met with you, because it's all done electronically now. So we're just here to give you the best pieces of the puzzle that we can so you can make the right decision for yourself. So again, give me a call, Joe Kehrig, my cell 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to learn more about the Kehrig team, www.kehrigteam.com. So even though things aren't moving a lot, make sure you tune in next time, because we are going to see, the interest rates are going to probably, they're thinking maybe the Fed will do a couple more cuts this year. So have a great week, and we'll see you next week.